Hi everyone, welcome to this episode of WealthAbility. And if you're watching replay, welcome replay viewers. So today is all about IR35. And are you still confused about all these public sector IR35? Because I work with a lot of doctors. They've been working within NHS as a locum doctor. So this IR35 has become a big issue to most of them. They are a certain type of doctors, they are not affected, but from April last year, because of this new rule kicked in, so quite a lot of them, I think a lot of trust, what they do is they have taken a blanket approach that assumed everyone is inside IR35. So that has caused a lot of chaos and a lot of issue. So today I think it's nearly the anniversary of these IR35 public sector updates. So I think it's worth having another go on what are the practical issues, as well as what are the questions asked by the client, especially if you are one of them, either you're working within NHS or other public authority, and you've been caught by this IR35, and if you still are uncertain or being confused about this whole thing, I think now the situation become a little bit more clear in terms of why government take this why government come up with these updates, as well as what are the tax implications, especially if you're under IR35 and you've been paid, still pay to your company, and you still have a limited company open, and this will be the episode for you. Over the last year, I've been asked by a lot of questions, a lot of things at that time when this new rule kicked in. Things like how you treat different transactions on the accounts, how you treat the income in your company accounts. Last year at the time, it wasn't sure. There wasn't a black and white rule about what you need to do. But now the situation become more clear, and now I think it's worth having a chat about this, so that of course it's nearly anniversary and it's nearly the time you have to do your first accounts that might be under IR35. So this is episode about what you need to do if you have an active limited company, but if you are inside IR35. And the second thing is very common thing as well, is what you need to do with your expenses. Are you able to still claim the expenses as usual, as you were before, especially travel? Are you still able to claim travel? And the third thing, there are certain people thinking about closing down their limited company because they think it's not worth it. So we'll talk about the practicals about that and what you need to consider when it comes to closing down the company. Okay, so if you're watching me live, be free. Hi, Davika. If you have any questions or have any comments about this relevant topic, be free to pop into the comments, so I'll be acknowledged. And let's stay interactive. And if you're watching replay, again, if you do have any comments or any burning questions, make sure you do pop into the comment box so that I will be acknowledged and I can get back to you. Okay, so first of all, I think the reason why the rule has been changing, of course, a lot of, from last couple of years, a lot of contractors, we have like sort of a lot of personal service company, because they are working as a contractor and they are freelancing. Well, freelancing is kind of setting up your own business. And then we have a lot of IT contractor, or because I work with doctors, they are doing locum work. It's like freelance work and working within a hospital or several hospitals, and then they've been paid either as a self-employed individual or as a limited company. So typically, limited company was very, very tax efficient. So that was why a lot of people setting up a limited company, typically as a personal service company. So these are one-man band companies, and they are working as a freelancer, and then they have the freedom working with more than one organizations, and then it's more on the temporary and on contract basis. So this happens to a lot of high-skilled professionals, especially in IT, in engineering, in healthcare, and also in finance as well, or like interim management. So these become very, very popular. Especially now, over the last couple of years, we are getting more and more people are become self-employed. In one of my previous webinar, I have done some research. The percentage of like self-employment is booming, and especially people being part-time self-employed, the ones who still keep a day job, keep a salary job. Maybe they work part-time on the PAYE, but at the same time they work part-time as a freelancer, so they have some freedom as well. So we are getting into a gig economy, and then because the tax, running a limited company, income is not much after tax. Yeah, that's true. The income as a PAYE it's relatively low after tax. So of course, being a freelancer, you have more freedom, and also you run a limited company. It used to be really, really tax efficient, especially before like 2012, 2013. That was the time you can have an income, have a little bit salary, and have some top up some dividends. You can have a basic rate income nearly like 30,000 tax free, but now not anymore. So last couple of years, I think after a while, the government start changing the dividend tax rule. So they want to closing the gap for people who want to set up limited company and do this kind of personal service, because of course they're probably not happy with it. And secondly, some people, they having a personal service company, but technically they are employed by their client. So that was really not fair for the counterparts who are just employed and do the same type of work. So that is really not fair. And especially from last year, for public sector, the government start having this public sector rule, say now, well, the rule actually, the actual change was, it used to be the contractor themselves, they will self-assess their situation, but now they want the end client, they want the fee payer to assess the situation for those contractors. But what happened within NHS is a lot of the hospitals, they just don't bother assessing every individuals, assessing all the consultants. So that was the reason a lot of hospitals, they are taking blanket approach, so that everyone, all the locum doctors are within IR35. So as a result, either a lot of them go back to normal salary job and close down their company, or they working if they've been working with agency, they transferred into the umbrella company. Or some of them still have an active limited company. They've been paid. The limited company still get paid, but it's after the tax being deducted. So April last year, I think this rule change and all this chaotic thing kicks in. But at the same time, the other rules, things like the guideline about how we count the income inside IR35 in our company accounts, and how we can avoid being double taxed, because when income come into the company, that's subject to corporation tax, and when you are taking the money out, then you're paying income tax, personal tax. So how we can avoid being double taxed not just being taxed on both company as well as on the individual on the same income. And also, there are things like expenses, what you can do. So Devika here said NHS is not good. How about private? So at the moment, it hasn't affected the private sector yet. So for the locum doctors, if they are working for the private sector, they can still do as usual. But it is likely that the same rule will soon apply to the private sector. But again, it is last year. It's just because lots of NHS trusts, they are taking blanket approach, or a lot of organizations. So we hope when it comes to private sector, it will become more more sensible. Just follow the rule, assessing every single individuals rather than taking the blanket approach. Okay, so yes, what to do? So first of all, like the first area, like the first issue is really how the income will be counted. If you are paid to your limited company, and after the tax being deducted, and what if you still withdraw the money from the company? So this is a very, very practical issue. So what happens is, say for instance, if you've been paid £2,000, that's supposed to be gross. And let's just imagine after tax, your net pay is £1,500. So yes, you have £1,500 coming to your business bank account. But because your gross pay is actually 2,000, so the whole 2,000 will be counted as your sales, as your company revenue. So when it comes to company accounts, that will be counted in the revenue. Make sure that's gross. And then, what if you withdraw the money from the company? Of course, anything you can withdraw up to that 1,500, which is tax-free because it's already been taxed. So there's no point that's being taxed. So that is tax-free. You can just withdraw. And then on the company accounts, you will have a direct salary that will match exactly that £2,000 to take it out, so that you can avoid being taxed twice for the same income. So there's on the accounts, technically it's £2,000 coming in, and then you as a director, you have £2,000 salary. So that is in and out, and no gain, no loss, so that the same income will not be taxed twice. But of course, that 2,000 gross and 1,500 net, that is technically, when you are inside IR35, that is technically an employed income. So in your self-assessment tax return, you will need to declare that £2,000 employment income and £500 tax deducted on your personal tax self-assessment. So that is how it works. So that you have the gross income coming into your company, but you are matching exactly the same amount as a direct salary, so that you will not be taxed twice. So that is how the company will be counted. Yes, I think in that way, that will make a lot of sense. That first of all, the same income will not be taxed twice, and secondly, because it's paid to the company, in a lot of cases, on the payslip, it's your company's name, but you have your own national insurance on that. So yes, the income belongs to the company, but at the same time, you have the exact amount taken out as a direct salary. So that is technically an employment income. So that is how the tax will be treated, and how your company tax as well as your personal tax, how this need to be done. Of course, you might be all the income being completely inside IR35, or you have partially, it's your normal freelance income, which is your Euro business, and only part of them is inside the IR35. So the same again, the same kind of issue will apply. Depends on how much income is under IR35. Of course, the other part that is normal freelance work, normal consultancy work, you can still do whatever as Euro and whatever approach is the most tax efficient. So yes, that is the income that is under IR35 and being paid to your limited company. Okay, so now next we come into the second question, that is on the expenses. So can you still claim the expenses as Euro? So first of all, if you still running having an active company, any professional fee, like if you still paying your accountant to manage your company accounts and all the outgoings that are necessary to the company, then these are still tax deductible. So yes, one typical thing is your professional fee and your bookkeeping software, all these software subscriptions. So these are still tax deductible. Of course, if you have, like I said, you might be partly inside IR35 and partly outside IR35. So when you are doing things outside IR35, any activities, any expenditures that is directly related to that part, outside IR35 activities, these are still tax deductible. So you can do things as Euro. But let's talk about what if you're completely inside IR35 or the part that is inside IR35. Yes, as said, or if you do still have an active company, like professional fee and any necessary subscriptions, these are tax deductible as Euro. But there are certain things like travel and subsistence. So just be careful on that. Travel and subsistence, because as a business owner as well as an employee, the way you can claim travel and subsistence can be slightly different. And of course, when you are self-employed, if you do travel elsewhere for client meeting, for perform your job, and if that's more than 5 miles away from your Euro workplace, and you work there for more than 5 hours, then you can claim the food and you can claim the travel. You can definitely claim the food. But for the travel, if that's a temporary workplace, you can claim the travel as well. For most of the consultants, like contractors, what they do is, because the definition of temporary is if you work for that place, if you go to that place, work there for less than 2 years. So for most of the contractors, they are still claiming travel from their home to their client's office, because they argue that this is under 2 years, and the home is their Euro home office, and the client is there, and they have the clients for less than 2 years, so they still claim that travel. But as an employee, you cannot claim anything from home to your employer. Technically, if you're inside IR35, that client is actually your employer. So if you fall into that, the claiming expenses rule, you will consider more of as an employee. So if you're a medical professional, as Euro, like some of you might have experienced that you claim the tax rebate from the professional fee, from the necessary travel, everything like that. So claim through your self-assessment. That's exactly so. So if you are inside IR35, and if you're medical professionals, so that would be more tax efficient in most of cases. If you put your if you claim your membership, your professional fee, your subscription, your indemnity, and any claimable travel through the self-assessments, because it is likely that your income will be on at least like 40% tax bracket. In that way, you can claim a little bit more tax back from the government, as opposed to putting inside the limited company, because limited company tax rate is 19% flat. So the amounts you can claim back is slightly lower. So yes, expenses, because when you, just like one thing to bear in mind is if you are inside IR35, you are technically employed. So when it comes to claiming expenses, think as if you are claiming tax rebate as an employee. But if you are partially inside IR35 and partially outside IR35, and anything that is directly derived to that, you can still claim as zero. And if you still claim in the travel and it's still legitimate, and that part you can still claim as zero for the area that is outside IR35. But by all means, even if you are inside IR35 and you have an active limited company, and if you're still paying an accountant to manage your company and paying any professional and legal fee or any subscriptions like software, so you can still put them through the limited company. And then if your company is making a loss, and you can carry back the loss to claim, if you most likely you have been previously declaring as a profitable company and you paid corporation tax. And then because of IR35, if your business is running at loss, and then you are able to claim your previous, you are able to offset the loss, take the loss back to the previous year and claim some tax back, claim some corporation tax back. So yes, that's a way to do when it comes to expenses. And thirdly, I think another popular question is closing down the company, because for some individuals, for some consultants, they might just think it's not worth them to keep the company running. They are not looking to set up business. They just want to do the job and get paid and be tax efficient. That is absolutely okay. So if they decide to close down the company, of course the company has to be at least 3 months dormant, and then make sure the company, there are two sections. So one thing to be aware of is the final assets of your company. If that's less than 25,000, then you can just do the normal strike off, and anything remaining, that will be counted as a capital gain. So because you've been as a company director for so long, and it is most likely that you can pay of course the capital gains tax, the first about 11,000. Everyone has a personal allowance on tax-free allowance on capital gain as well. So first of all, there's a capital gain tax-free allowance, and secondly, anything exceed that, you only pay capital gains tax at 10% instead of like normally it's either 10 or 20%. So yes, you can get the entrepreneur relief. So for most of the doctors, you are paying tax at 40%. You're high rate taxpayer. So for high rate taxpayer, the capital gain is 20%. But because you're being a company director for so long, and it is likely that you qualify for entrepreneur relief. So entrepreneur relief, that means you only pay capital gains tax at 10%. And only for the part that is exceeding the tax-free allowance. So that can be very tax efficient as well. But bear in mind that it's a final asset that is less than 25,000. For most of you, it is most likely the cash sitting in the company. So just having a look at the company, if you have less than 25,000 in the company, and it is most likely that you can just apply for the strike off. But if the asset is more than 25K, you might need to either wait a bit until you are able to get it down below 25K and do the normal strike off, or you just use a solicitor. You might need to apply for members' voluntary liquidation, and you need to use a proper liquidator. So at that point, the professional fee might be quite high as well. So that's something you also need to take into consideration. So yes, if your final asset is more than 25K, one thing you need to think of is, first of all, if you go for liquidation, and the professional fee will be a lot higher than normal strike-off fee. And secondly, for the tax-wise, if that's under 25K, and everything will be declared as a capital gain, but over 25K, it's a lot more complicated. So there's a complication you need to think of as well. For most of you, it is likely that you might want to leave it off for the bit and then wait until it's under 25K. You might want to, in the meantime, extract something before you close down, and you want to wait a bit. Or if you just want to strike off, you don't care, and you just want to close it down as soon as possible, avoid any complication, that is fine also. And yes, you might go down to the normal liquidation. So yes, it's different from different individuals, but if you are looking to get more information on striking off process, be free to get in touch with me as well. So we can have a look at your overall situation and see which is the best option for you. But of course, I think for this, keep the company open or not, you really need to consider the long-term perspective. For some people, they might still want to go back to the proper consultancy work, or even eventually want to set up business. So that's one of the reasons why those people still keep the company open even if they are inside IR35. So yes, whether or not you want to, or it's appropriate for you to leave the company open, first of all, you need to look at your long-term perspective. If running a company, is that something eventually you want to do? And secondly, looking at the cost effectiveness as well. Keeping the company open, you need to consider obligations still need to fulfill for the company, and for not just for the cost-wise, the monetary cost, but also the time as well. You need to consider yourself as well as the company, and yes, and at the same time, all these IR35 complication come into play. But I suggest, if your long-term perspective, especially in next 2 years, you want to get back into a normal business, or if you already started a business and carry on some activities, then you can still keep the company open. But if that's not your long-term vision, and that's absolutely fine. So it might be worth for you to consider the option of closing down the company. Okay, so I think this is what I would like to share for today. First of all, we shared what we need to think of when it comes to declaring the tax, declaring the income that is under IR35 and paid into the limited company. So as we discussed, we have the sales, gross income as sales for the limited company, but we match the exactly same amount as the direct salary. But also don't forget to declare the income as employment income in your self-assessment. And secondly, we talk about expenses. So inside IR35, you're technically an employee. So you might the logic will be any expenses related to the work that is inside IR35. You will think as if you are claiming expenses as employee. But for the rest of the work, and you can just do as usual. And thirdly, we talk about the options to close down the company. yes, you really need to look at your long-term vision, and if eventually running a business, if that's your long-term vision. If that's not, you might want to think of the option of closing down the company. Okay, so as always, if you do have any questions, be free to let me know. And just so you know that this is for education and for the guidance only. This is not a replacement of professional advice. So if you do have any questions that is related to your specific situation and you want some tailored advice, be free to reach out to me. So I have my own Facebook group as well, a tax deductible lifestyle tribe. It is in the description, so click the link and join me so you can get more in-depth resources on money and on tax. And if you, as always, if you do have personalized questions, and always reach out to me personally, and so that we can have a chat and we can have a private and confidential conversation about your next steps. Okay, so I hope you find this one useful, and my name's Hannah. I help you discover your ability to create wealth, and this is a WealthAbility Live. I hope you enjoyed it, and thank you very much, and hope to see you soon. Bye now.